What was your takeaway from Kevin Warsh's speech? Do you think that the Fed chair set the right tone at a pretty inflationary moment for the global economy?
First of all, thanks for having me. It was very interesting to hear his assessment of the state of the economy in America. It was interesting to hear what he thinks drives growth and what kind of uncertainties and what kind of challenges are out there. And he was very clear about the target, the 2% inflation target of the Federal Reserve and the commitment of the FOMC to deliver. So I think it was a clarifying speech and interesting to listen to.
Just to give some perspective, central bankers from all over the world come here, like yourself, to hear what the Fed has to say, but also to talk with their colleagues. How important is it to European central bankers to hear what the Fed has to say or what the Fed has to do? In other words, how much is the Fed still central bank of the world, as it used to be called?
It is, of course, a very important central bank. The dollar is the reserve currency in the world. It's a very important currency in transactions. So it's very important to listen to, but it's also very important to speak to each other, to work together, to communicate, to find a common assessment of the challenges we have. And we have several of these occasions. One is here, one is in Europe, in Sintra, close to Lisbon in July. So I think it's important to keep the dialogue open and to discuss the assessments that we have on the developments in the economy and, of course, the dangers we are facing.
So there are a lot of similarities, there are a lot of differences between the U.S. and Europe, but there are some similarities in that growth has been stabilizing. It just came in above expectations in the Euro region, while inflation is above target and has been for a long time. It is slightly different in Europe. There is a stronger input from higher oil and gas prices. You've talked about maybe September being appropriate for a rate hike. Does it seem like there is increasing kind of momentum behind not just one, but a series of tightening policies to try to get inflation under control?
The important aspect now is whether the inflationary pressure we see is more long-lived. And we don't know yet very well, but we will have our projections for our next meeting very soon. And we see that oil prices are on a higher level for an extended period. We see natural gas prices in Europe going up and the forward prices going up. So there is, of course, a certain threat to price stability. On the other hand, the ECB is fully committed to its 2% target. Our current inflation rate is around 3%. We'll see the new readings for August very soon. So there is alertness, there is no complacency, but the situation is different than in 2022, where inflation rates were around 10%, so a very different situation.
The market's pricing in almost fully an ECB rate hike in September. How do you determine whether you need to go further than that? How do you determine whether there needs to be a series of tightening versus just simply a one-time adjustment to try to calibrate policy?
The projections that we're going to get for our next meeting in 2 weeks will be clarifying in that respect. At the moment, we expect 2.3% inflation in the euro area next year in 2027. You know, the 2% target is a medium-term target, so this is the important figure that we have to look at. And, of course, the risks associated with the inflation projections. It's good to know, and you mentioned that the economy is stronger, more resilient than actually was expected. But clearly, we deliver on our target and we will do everything necessary to bring inflation down to 2% in the medium term.
What would you have to see to go further? I mean, what are you looking at to determine whether it really does require greater tightening?
So what we're looking at the moment is, of course, the developments on the fossil energy markets, but we also look at indirect and especially second-round effects. So wage bargaining in autumn will be important in determining where there might be longer-term effects of this inflationary pressure that we're seeing at the moment on the markets. There's other, of course, second-round effects in manufacturing, in food prices that might appear. There is no clear evidence yet, but this will become much clearer during autumn, and that will determine the rate path in the future in 2027.
It's incredibly appropriate that this August gathering is occurring right before the G20 meeting, where finance ministers and central bankers get together. And the reason why it's so salient is because of the fiscal overhang in developed markets right now. That a lot of governments are dealing with deficits that have deepened significantly in the Euro region. France is a serious concern right now. In the U.S., the $40 trillion debt pile, not exactly comforting. How difficult is it for central bankers to set policy purely looking at goals when there is this fiscal overhang that kind of creates this instability, just sort of not necessarily taking into account inflation the same kind of way?
There's clear responsibilities. The central banks are responsible for monetary policy and inflation. The governments are responsible for their budgets. But it's clear that there are interlinkages. And we have been saying that repeatedly, and the IMF has been saying that it's important to keep public finances on a sustainable path. Otherwise, there might be spillovers in other areas. And it's in the interest of all the countries. And I think the long period of very low interest rates in many countries led to a different assessment, but we have to be careful now. It is important to consolidate budgets. That's true for many European countries, but that's true also for countries outside of Europe.
But how does it complicate monetary policy?
It is, of course, there is long-term effects that matter for monetary policy. In the short run, we need to coordinate what we're doing in terms of the effects on the economic activity. That works very well. It's a long-term perspective, and it's a long-term aspects that are interlinked with financial markets, for instance, that are important. And there is, of course, important decisions to be made. And I'm sure that the G20 are talking about the imbalances that we are facing. It's not only fiscal policy and budgets. It's also, of course, other imbalances in trade that we have been talking a lot about, and we need some solutions to.
You were talking about how it's important for global central bankers to come together and to have a conversation. And a big part of that conversation is artificial intelligence and how that's transforming the landscape in ways that are somewhat unpredictable and difficult to discern. Do you get the sense that there is agreement that it is more inflationary than disinflationary? Where is that debate kind of coming down during your discussions here?
So my personal take on it is we don't know, and there might be different points in time where it has different effects. Perhaps at the beginning, it might be more inflationary because you need resources to build data centers and so on, and that could increase inflation, at least slightly. In the long run, of course, it increases productivity. It allows for higher growth levels. It might be disinflationary, but it's really too early to say. We have lots of academics around us during the meeting, and there's different opinions. I think this conversation continues for sure.
The other difficult aspect is that a big driver of inflation has been these supply shocks, consecutive supply shock after supply shock. It's come to the point where you can't look through them, and that's kind of what people are saying. How much are you reframing your view of supply shocks, and how much do you think that the ECB has to reshape its view? Or do you think that ultimately, if inflation is too high, it's too high? It doesn't matter what's driving it. You need to raise rates and lower it, period, the end.
So first of all, I think there's one aspect that you mentioned. We have more supply shocks than before. That's something to take into account. The second aspect is more psychological. If you have these supply shocks repeatedly, then the price level becomes more important for consumers, not the inflation rate, the price level. So it's even more important to be credible as institutions, to anchor inflation expectations and to make sure that there's clear commitments to the targets. And if you have repetitive supply shocks that we have been seeing recently, this is even more important now. So central bank independence, central bank credibility becomes more important than in times where you have fewer supply shocks and fewer of these instances.
How solid do you think that the European economy really is? Or how much do you think that you're seeing a blip upward, but there still is this instability or at least fragility under the surface tied to all these supply shocks, tied to the vulnerability with higher oil prices, tied to some of the questions around China and the price shocks coming in and some of the trade aspects coming there?
I think the European economy is more resilient than many people think. It is showing some momentum now, more momentum. It has been showing that already at the end of last year and beginning of this year, but there was the interruption of the Iran war. We don't know what's going to happen. There's lots of uncertainty. There is structural challenges for Europe, but overall, I think the European economy is better than many people think.
Do you think that the currency is in a good place to try to not affect necessarily inflation one way or another? How closely do you watch the euro as sort of a gauge of that?
You know, it's not a policy variable for the ECB. Of course, it's one of the variables we're looking at, but there is no development at the moment that I would highlight or flag. But again, as I said, it's not a variable that we are using as a policy variable.
Do you envy the fact that the Federal Reserve just has to deal with one country versus the myriad countries that make up the European Central Bank with very different views on their local outlooks as well as what they would like interest rates to be?
The fragmentation in Europe is sometimes, of course, a bit of a challenge, but it's not so much for monetary policy. The developments are much more homogeneous now, and within the US, there's also differences in terms of economic activity and economic developments. So it's a bit different. There's more homogeneity, but it's just a different scale. We are all dealing with, of course, regional disparities within our currency areas.
Is this the most difficult conference for you to get to of all of the of all of the confabs?
It is one of the most difficult ones. That's true.
Well, thank you
but it's
so
one
much.
of the nicest ones.
Exactly, especially when the clouds clear. Thank you so much.